Hello, investors and traders, and welcome to the weekly market report. I'm AJMonte, Chief Technical Analyst with Sticky Trades. And the big news this week was that the Fed was leaving rates unchanged, but the markets didn't like what they heard after that announcement was made, and that was that interest rates were going to remain higher for longer, and that more or less put the kibosh on the bullishness out there. And let's get right to the charts. We hit the targets all around 100%. And as you can see here, we have the downtrend here with 6 red candles in a row. If I zoom in a little bit further, you'll see that we have a drop in volume on this last candle here as I record this on Friday the 22nd. Now, if you take out your trading checklist and look at the buy signals versus the sell signals, I'll check that off for you right here. Again, we have a long stretch of red known as a stale red light. That's actually bullish. We have a wide divergence from that 20-period moving average. That is bullish. We have a gap above the market right there. That's going to act as a price magnet. That is bullish. The stochastic down below is oversold. That's bullish. And while the CCI is oversold, you can see that we have a hinge forming towards the upside. And that too is bullish. Now, what can we expect for next week? Well, I'm going higher on my forecast right now. So as I draw my zip lines, you'll see that I'm moving up towards that gap fill. And it might seem a little extreme. While I do think that gap does have a chance of filling, I'm playing it safe with my upside target for the diamonds at 343.40. At which time, once that gap fills, or should that gap fill, it's going to act as resistance. And from that point on, I say watch out below, because that is also a role reversal where former support turned to resistance is going to give the market a tough time going any higher from there. So if we get a pivot point, we'll have to see the week after next. If we get a pivot point lower, then watch out below. I think you're going to see the bears moving in with force. So again, that is DIA with my upside target right there at 343.40. Moving right along in alphabetical order. IWM, it's pretty much going to be the same story. We hit the downside target right here of 181.78. We do have a drop in volume after 6 red candles in a row. Going up from there towards filling that gap. That upside target is 179.54. Here is the role reversal line. Just above that gap fill point, we have another resistance area right here. CCI is hinging higher after coming out of an oversold condition. The stochastic is oversold. Wide divergence from the moving average, same thing. So again, 179.54 on IWM. Moving right into the Qs. The Qs got smacked this week. You can see we're right down here to fan line number 5. This is an inverted hammer. Let me zoom in just a little bit more. It's when you have a long shadow above a small body candle at the end of a downward leg. So this downward leg showing a bullish sign right there leads me to believe that the Qs will also rally. We have a drop in volume on the way down. Again, that is bullish. And so I'm moving the Qs all the way up to the gap fill point here. And so that is a target that I think is most likely going to hit either Monday, Tuesday, or at the very latest Wednesday, and then we'll have to see if we get a pivot point lower. So again, the Qs, upside target at 363.98. Look down below, stochastic pretty oversold right there. Most oversold it's been in months. And the CCI coming out of an extremely oversold condition, hinging higher. Wide divergence from that moving average once again, and you can see by looking back, I'm leaving all of my previous price targets up there so you can see how often these price targets hit. We hit an upside target here, then right after a downside target. We hit the upside target here, still waiting for that downside target to hit. Upside target hit, downside target hit, downside target hit, upside target. We'll have to see next week. I think there's a high probability that will happen, so stay tuned. I'll give you another report on Wednesday during the midweek report. So again, to reiterate, that target is 363.98. Moving on to SPY, you can see here that we are now below this key support level here. It's going to struggle on the way back up because that key support level, once broken, turns to resistance. We'll have to see. I'm still going higher on the SPY up towards filling that gap. at 437.01. Same story. We have a drop in volume on the way down. Stochastic is extremely oversold. CCI coming out of an extremely oversold condition and pivoting higher. And again, that wide divergence. Now with the SPY, we have three gaps above the market. We have this gap, and this gap. I do not think we're going to see that gap above the moving average fill so quickly. So I do think this gap could fill, and then we're off to an ABCD pattern. Lower prices ahead is what I see in my sights. Now going into the VIX, for those of you that are following the midweek report, I made an announcement on the YouTube channel. I'm going to get to that in a bit, so you can stay tuned by hitting the notification bell on YouTube. You're going to get an update on my comments when I put them out on the videos midweek. I did say that we would most likely see the VIX hit the target. It did that yesterday. And what do we have here? That little body candle with that long shadow underneath that small body is known as a hanging man. This is a wide divergence between the %K and the %D. So I think that the VIX has a high probability of dropping next week. Now remember, for the most part, the VIX is inversely related to the S&P. So if the VIX drops like I think it will, and I'm going as far down as this roll reversal here, I'm going to put this up temporarily, but I'll remove that when that target hits. My downside target for the VIX is 1570. My main reason for going so far down on the VIX is because of this wide divergence between the %K and the %D. %K is the blue line, %D is the red line, and you can see it's been a long time since we've had such a wide divergence like that. CCI is already heading lower today as the market closed. That CCI started going lower. So again, that's bearish for the VIX and bullish for the S&P, at least for the short term. Now, let's go to the geopolitical news. Many of you are keeping track of what's happening on the southern border. Please, we don't need any political comments. This is a fact. What's happening, we have a crisis on the southern border. And last night, I took a survey of all of our veterans that were in the group for the webinar last night. And I asked our veterans, as we looked at this photo here, we actually looked at video, and I asked the veterans, what are you seeing here? What kind of behavior? What are you seeing that's very unique that stands out to all the veterans? And the comments started coming through the chat board in sync. All of our veterans identified this as a column march. For those veterans that are listening to me right now, you know exactly what a column march is. What is a column march? Well, when you're going to battle or if you're on patrol, now I was a former CB. I've changed rates in the military a couple of times. I was in Airedale, then I switched to the CBs. We used to march in single file, more or less. I'll leave that out for a simpler description. But this is what military folks do when they're marching on patrol. Civilians typically do not walk this way. They'll walk side by side. They'll swap water bottles. They'll talk, have conversations. This is single file all the way, folks. And the other thing that concerns me is that these are military age, very young men, single men. There's no families in here. Don't you find that a little odd? So something is brewing. I can't tell you exactly what is brewing, but how does this relate to the market? Well, it's going to affect our economy. Number one, our social system does not have enough right now to support such a large migration of folks such as this coming over the border. That's number one. Number two, it's going to put a crimp in the job market. It's going to suppress the hourly wage quite dramatically, which is going to put more pressure on those trying to earn a living with a recession on its way. Now, when you couple that with what the Fed said this week, the Fed is going to keep interest rates higher for longer, and a lot of the analysts are reporting that this could reach out through 2026. That surprised me. I thought maybe through 2024, but this is definitely going to put a hurting on our economy, and most likely we're going to see higher inflation down the road, because if they're pausing on interest rates and inflation is still rearing its head with higher energy costs, right here you can see that national gas prices are on the rise right across the board. Whether they're measuring energy and food into the equation, this is definitely going to have an impact, because higher fuel costs, higher food costs are going to push inflation higher, no matter how they try to coat that and how they report on inflation. It's just going to go higher, and you could see it. It's going to start with oil and trickle into the rest of the economy. Now, if you look at the rate of bankruptcies that are on the rise here, I put a couple of things out on Twitter from folks. One was an attorney and one was reporting from an attorney. Bankruptcy attorneys are seeing an extreme lift in the number of cases that they're representing. And you can see here, one of the reasons why is that the delinquency rate on credit card loans is now at a new 10-year high. What happens? Well, people are having trouble paying the bills. They've taken out too much revolving credit. That in turn is leading them to bankruptcy, like I just mentioned. And the story continues. This is not hinging lower like we see on the CCI or a trend. This is trending in a very dramatic way, greater than a 45-degree angle on this particular chart. There is no relief in sight here, and I think we're going to see a lot higher. And this is coming from the Federal Reserve in St. Louis. You can go out there and pull these reports up yourself. Just Google FRED, it's the Federal Reserve St. Louis, and you could put in these charts any which way you like. There's so many different data points that you can measure, and that's what I've done. Now remember what I told you about the YouTube page. If you subscribe and you hit the notification bell on the top right corner of the page, you're going to get notified, number one, when the videos come out. But I'm adding a feature to this where I'm putting comments in and then I'm making comments on my own comment. And that might sound a little crazy, but what happens when I do that, you will also get notified when I make a comment. And I'll be putting out more comments during the week, especially if I see a turn in the markets that are relevant to some of the strategies that we're trading with our members. So again, thank you so much for liking, sharing, subscribing, commenting. It means a lot to us, and it helps the algorithm to get us out there more to the public. And I have all of you to thank for that. So have a great weekend, and we'll talk to you on the next video. So long.